In the last class, in capital structure theories, we have completed net income approach, net operating income approach, and traditional approach. Okay. In case of net income, net operating income. Under net income, changing factor being what? KO is the changing factor. Is that okay? As KO is changing, there will be impact on the value also. In case of NY approach, due to inclusion of debt equity, there will be savings. Okay, but that savings is taken by whom? KE. So changing factor being KE. As the KE is changing, KO remains constant and value also remains constant. These are the two cases. So we have to understand two capital items are there in capital structure. One is equity, another one is being the debt. Collectively, we can call this being the KO, cost of overall capital. Is that okay? Under NA approach, KO changing. Under NOI approach, K is changing. See, if I draw the diagram this way, okay, based on the debt equity mix, always remember K is higher than the KD. They usually demand more because they are being the risk taker, so demanding more for their risk taking ability. KE. Okay. Now, so as per the NA approach, KE remains constant with higher value. KD remains constant at lower value. As per this logic, KE should be higher than the KD. If you are increasing the debt proportion in your capital structure, overall cost of capital will be decreasing, gradually decreasing. That's the logic. This is the K. So if you are financing your business requirement by equity, where the equity may be having a cost being 10%, KD being 5%. This is cost. If you are sourcing your fund with 10% capital, your cost is also 10%. Overall cost is also 10%. If you are financing out of the debt only, your cost is only 5%. A portion of equity as well as a portion of debt. For the debt, it's only 5%. For equity, it's 10%. In that case, proportionate debt will have the impact on KE is a KO. KO will be decreasing here. So if you are keeping no debt, only equity business, then what will be your cost? This is 10%, this is 5%. You don't have any debt component. You have purely what? Only equity component. As you source your fund requirement by equity, the overall cost for the company being 10%. If you are sourcing the company's requirement, capital requirement only by debt, how much you have to pay? Only 5%. Only 5%. So KE is equal to 10%, KD is equal to 5%. If you are sourcing that purely debt, your cost being 5%. Okay, so it's purely debt, it is purely equity. In case if it is being the purely equity, your cost being 10%. If it is purely sourced out of debt, it is 5%. But in case of proportion, some proportion of debt and equity, this value will be gradually decreasing and matching with this. So the higher value will be for KE, the lower value is for KD, and this item will be considered as, this item is considered as KO. Okay, KO. So the KO is gradually decreasing as you are financing out of the debt component. As you are financing debt component, it has a lower cost, your overall cost for the company will be diminishing. That's what about the NA approaches view. NA approach view. Suppose if you go for NOI approach, KD being 5 percentage and KE being 10 percentage. KE being 10 percentage. If there is no any debt, pure equity, your cost should be 10%. Am I right? Overall cost should be 10%. Unlevered firm, KO is equal to KE. Both are same. Both are same. But when you are including the debt component, there is a savings, but that savings will not make any impact at the KO. The KO remains the same at the 10% rate. Because of including the debt component, you will be saving money, right? So that money is taken by whom? KE. So as the debt equity mix is increasing, automatically KE requirement is also increasing. This is KE. Benefit by mixing the debt component is now taken by the equity shareholders. There is no any gain for the company. There is no any gain for the company. Is that clear? This is the logic you have to understand. This is the logic you have to understand. Any doubts here? This is called NY approach. This one is called NA approach. NA approach. As per the NA approach, the diagram being this way, KD will be the lower value, KE will be the higher value, and as the degree of leverage is increasing, the degree of leverage is nothing but debt equity mix. When you are mixing the debt component in your capital structure, then it is called levered. How much is levered? It's a 30% levered or 40% levered, 50% levered. That will be called as degree of leverage. If the degree of leverage is increasing, where debt component is also increasing. As debt component is increasing, the cost for the debt is reducing. As the cost for the debt ultimately reduces the overall cost of capital. So we'll think the overall cost of capital will be gradually decreasing. This is KO. But in case of net operating income, KD being 5%, but because of adding the debt component, there will be savings, but there is no savings for the company. Because that savings is now taken by whom? Equity shareholders, KE. Clear? So the dotted broken line represents the changing activity, changing cost. Okay, under NA approach, KO is changing. Under NY approach, KE is changing. But practically, this is also not true. This is also not true. Anywhere between these two will be true. That's why a new approach comes here, traditional approach. As per the traditional approach, you know, okay, what happens? KD and KE, naturally. KD will be lower and KE is higher, naturally. So once the business is earning good money, what happens? The debenture holders are interested to invest here. Okay, so I too want to invest because this company seems to be very genuine one, giving good return. So I want to invest. So if I demand what could be your rate of interest, sir, I will give only 5% or 6%. Okay, so 5%, 6%. The KD remains 5% or 6%. Equity shareholders, by adding small amount of debt, will not be a big issue for us. For 1,000 rupees, only 50 rupees debt, it's not a big deal. I'm very happy with that. If you are adding only small amount of debt, there will be small amount of savings. Give me small appreciation for me, I'm very happy. Otherwise, the KE also remains constant for some time. When it seems to be riskier, automatically what happens? Debenture holders, sometimes later, 1,000 out of that debt being 50, equity being 950. Sometimes later, 500. Seems to be more riskier. Now what happens? Debenture holders, already we have funded almost 50% of your capital requirement. An earlier case, only 50 rupees, it's very risk free. So I demanded only 5%, 4% or 5%. If you demand 500 rupees, then risk is increasing. So I need 6%. Okay, so now naturally the cost of debt is increasing after a certain time. Not only that, equity shareholders will also now demand, sir, earlier I'm happy with the 10%. Now 50% debt is there. Very risk position for me. If there is even small loss, you have to offer to 500 rupees, means debenture holders only. Leftover money will be very, very lesser and may spoil our income also. So we need to get at least 12 or 13%. This 10 increases to 12%. This 4 increases to 6%. So KE after sometimes will be increasing. KD after sometimes it's increasing. And due to this, initially what happens, initially this KO is decreasing. The moment these two costs is increasing, the KO is also gradually increasing. Clear? Now you have to draw a straight line touching the lowest tangent of KO's curve, lowest rate. This will be the optimum debt equity mix. This will be the optimum debt equity mix. Most probably 20%, 40%, 60%, 80%. This may be the debt equity ratio, where approximately 50%, 50% debt and 50% equity will be better. That's how you can make the decision, which is called traditional approach. KD is also be lower to certain extent, thereafter increasing. K is also lower, thereafter suddenly increasing. Due to these two costs increasing, the KO in between also be decreasing certain level, thereafter increasing. From this, in KO, the lowest point in this line will be marked and make a straight line. This is called optimum capital structure. To that extent, you can have the debt equity mix, maybe 30% or 40%. What you find at this point will be your optimum mix. So, traditional approach diagram. A midway between NA approach as well as NY approach. It's not this way or that way. It's not NA or NY. It's anywhere between NA and NY. It seems to be more logically acceptable. Assumptions. The value of the firm increases with the increase in financial leverage. Okay. If you are increasing the financial leverage, value will be definitely increasing to certain level because KO is decreasing. If the denominator value is decreasing, the numerator value is same, then automatically what happens? Value will be increasing to up to certain level. What's that level? The optimum mix. Up to certain limit only. KD is assumed to be less than KE always. That's a default understanding. Now, as KO is decreasing up to this point, value is increasing, isn't it? Thereafter, KO is increasing, due to that value is also decreasing. Why do I want to allow my company's value decreased? I don't want to go for that. So I stop here itself. My debt equity ratio should be this level. Okay. So here pure equity, here pure debt. So if you are moving anywhere in the x-axis, this represents some portion debt, some portion equity. The movement to the right side, where the debt is increasing, the movement to the left side, origin, equity is higher. Is that clear? So the optimum one being this one. Traditional view on the relationship between leverages and KO and then value is given in this picture. Is that clear? Hope I just explained all the calculations of the previous class. In this class, I just give the connections of all these things as a summary. Clear? Now, let's start with Modigliani and Miller approach. Modigliani and Miller approach. So, Modigliani and Miller approach. If NI as well as NY approach, two approaches are given. Okay, what these two approaches suggested. Okay, NA approach suggested that the KO is decreasing and value is increasing. NY says that KO remains constant, KE is increasing. That's what about the suggestions. No change in the value. No change in the value. Is that okay? No change in value. Is that clear? This is how we learned. And Modigliani Miller came and he just chose this one being the correct. NY method seems to be correct. Right. And for that he gives a homemade example also. I'll just guide you that homemade examples also to make you understand the approach. Right. But he got lots of criticism. Then he shifted his view from here to here also. The first is theory being in favor of NY approach only. Later he moved to NA approach. NY to NA approach. Is that clear? The following data related to the company SBB Limited as well as SSA Limited. Two companies are there. We have been given net operating income, debt, cost of capital before tax. SBB Limited has no debt component. If you don't have the debt component, then it is unlevered firm. In case of unlevered firm, you know that KE is equal to KO, isn't it? KO is equal to KE, whatever it may be. Now, required, use Modigliani and Miller approach. Determine the value and KE as well as KO for both the companies, assuming no tax. Assuming no tax. Let's try to finish up this calculation, keeping which idea in your mind? NY idea. Because his first theory is all about NY. So as per NY approach, the value remains same. If you find out the value for unlevered firm, that remains same in case of levered firm also. If you are including the debt also, the company's image will be the same, the value remains the same. Is that clear? Yes. Net operating income. Net operating income, you can have the 9 line here: equity, debt, value, net operating income, and minus interest. Then you will be getting NI. You will get NI. Is that okay? Now, remember, here we have been given tax also. So in that case, I can subtract the tax, I will get the NI. This one is nothing but earnings before tax. This one is earnings after tax. These two lines will come only in case of Modigliani-Miller approach. Without tax effect, the MM theory is equal to NY theory. By including the tax rate, it will be totally different. We'll see that later on. So I'll just have two extra lines here for the MM approach. And KE, KD, and KO. KD, KE, KO. Net operating income in the very first scenario for SBB Limited, the value being 10,000. 10% debt. 10% debt. And KO being 12.5%. And this will be unlevered firm. In case of this being unlevered firm, KO is equal to KE. KO is equal to KO, KE. This 12.5 will come 12.5 here also. 12.5 here also. Is that clear? KE and KO. And we assume that we don't have tax. Okay, we assume the first case, assuming no tax case. Okay, always we work with the basic model first. Now, interest is 0, NI being 10,000. Yes, calculate the equity. NI by KE will be the equity. So, NI is 10,000. 10,000 divided by 12.5%. 80,000 being the equity. Here we don't have the debt, value being 80,000 rupees. SBB. Now, in case of SSA Limited, we have been given net operating income being 10,000 and debt being 30,000 and interest on that being 10%. And for 30,000 at the rate of 10%, interest being 3,000 and NI being 7,000. Right. Now, how can you proceed? You don't know the equity. To calculate the equity, NI by KE, but you don't have the KE here. So, if you have the KE, you can get the value. You don't have the KE. So, okay, then if you go for value, NY divided by KO, KO is also missing. But now you have to understand the logic of KO. As per the KO, what happens? These two are same and value is also same, isn't it? That's how you can assume. Under NY approach, KO remains constant and value remains constant. It will not be changing. NY approach says. Okay, from this logic, I confirm this one. So this is very, very important one. Okay, if any information given, you can take it. If no information given, then you have to assume the levered firm's value is equal to unlevered firm's value. Levered firm, because as per the NOI approach, the value will not change due to the debt equity mix. As per the logic, the value of unlevered firm 80,000 becomes the value of unlevered firm. This is unlevered firm. This is levered firm. Sorry. Okay, in this case, KO remains constant. KO and value remains constant, isn't it? So that's the logic. So I have completed these two values. Now you can calculate the equity also easily. 50,000. And come on, calculate the KE. KE is nothing but NI by equity. 7,000 divided by 15,000. 50,000, 14%. KO can be calculated this way, NY divided by value. Already we got the value being 12.5%. Then you can crash verify. NY being 10,000 divided by value being 80,000 rupees. So, come on, tell me, 10,000 divided by 80,000, you'll get the same 12.5%. No problem here. Is that okay? Now, what happens in case of with tax? With tax, okay. So, with the tax, how can we calculate? Clear? For SBB, unlevered firm, NY being 10,000, we don't have interest, NI being 7,000, tax rate assumed in this case being 30%, value of unlevered firm is also given 80,000 rupees. This one is 80,000 and tax rate being 30%. 30% on NI. This may be considered as NI before tax and this is NI after tax. EBT and EAT. NI before tax 7,000, out of that 30% will be the tax rate, so which is 2,100. If I subtract, then EAT being 4,900. Value is already given in the question itself, so just put it. And of course, we don't have the debt here, so equity should be 80,000 rupees. Come on, get me the equity value. NI by equity. Huh? Okay. NI is 10,000. Tax rate 30% is 3,000 and NI being 7,000. Good. Okay. Come on, find out the KE. 7,000 for 80,000 rupees. 7,000 is for 80,000 rupees of equity. 8.75 will be the KE. Of course, we don't have the KD and KO also being 8.75. Always remember, in case of unlevered firm, KO is equal to KE. Whether it is before tax or after tax, whatever it may be, the value will be the same. Ultimately, this value is nothing but multiplication of 1 minus t with this. 12.5 into 0.7. That will be the value. Okay, that will be the value. In case of SSA, in case of SSA, $30,000 being the debt component, NY being 10,000, interest component being 3,000, 7,000. You have to pay the tax on this at the rate of 30% is 2,100. 4,900 being the NI after tax. NI after tax. Come on, find out the KD. How can you calculate the KD? Interest by debt into 100. Interest 4,900, debt being 30,000 rupees. So 30 divided by 4,900, sorry, 3,000. But there is an impact, tax impact. So into 1 minus t, into 1 minus t. Otherwise it is 7%. 7%. KD before tax 10%, you have to multiply with 1 minus T. So ultimate KD being only 7%. So we have subtracted this 3,000 rupees before tax. After subtracting the 3,000, whatever the leftover now for the equity shareholders, on that only we have calculated the tax. Is that okay? Though you are debiting 3,000 rupees in your P&L account, actual expenses for you is nothing but 1 minus T. 3,000 into 1 minus T, which is 2,100 is actual expenses. When there is a tax, to the extent of tax will be savings. To the extent of tax will be your savings. Otherwise, KD after tax being not 10%, it's only 7%. Clear? Now, I don't know the KE, KO, equity as well as value. How can I calculate this now? Clear? Now, I introduce one new formula here. Value of levered firm is equal to value of unlevered firm plus D into T. Okay. Clear? Value of levered firm is equal to value of unlevered firm plus D into T. Let me explain that here. Okay. In case of no tax, value of levered firm is equal to value of unlevered firm, isn't it? But in case of tax, if tax is applicable, value of levered firm is equal to value of levered firm is equal to value of unlevered firm. Not only that, two extra items are coming here. Can we decode this one now? Can we decode? D represents debt portion. What about the T? Tax. Because of the tax item there, to the extent of tax we save on the interest component. If you are saving any amount, it may be capitalized. The capitalized value is nothing but debt component. Debt component to the extent of T, you will be getting benefit due to the tax effect. To that extent, the value of the levered firm will be increasing, naturally, isn't it? See what happens if you expect 10% return. Okay, for 10,000 rupees at the rate of 10%, how much you will get? 1,000 rupees. 1,000 rupees. But if you are being the taxpayer, you have to pay tax at the rate of 30% on this. 300 will go off, so your net benefit being only 700 rupees. Am I right? So, as the managing director of this company, CFO of the company, I am calling for a discussion. So, you will be ultimately getting only 700, right? Though I pay 1,000 rupees after tax, you will get only 700 rupees. Will you be happy if I am giving 700 rupees without tax? You don't need to pay tax. How much do you want? So, 700 rupees, sir. Without tax, you can get 700 rupees. As per your expectation is 10% is your return. Isn't it? So, for 700 rupees, what could be the overall investment you have to do at the same 10% return? Or here, what is your ultimate return? 7%. Though it is 10%, your net effect being only 7%. If I offer 1,000 rupees without tax, what could be the worth you can consider? 1,000 divided by 7%. 1,000 divided by 7%. Come on, tell me what is the value? Isn't it? 14,285. For 10,000 rupees, due to the tax, you will be getting only 700 rupees. Isn't it? Now what happens? Though it is 1,000, you are getting only 700 rupees. I say now, no need to pay tax, sir. You can keep all the 1,000 with you. Then automatically you will be feeling that it's worth more than that. Isn't it? That is a logic we have. To the extent of tax on the debt component, the image will be boosted because of the tax savings. So the value of the levered firm with the tax will be equal to value of unlevered firm plus savings and the interest tax component. To the extent of tax component savings, you can capitalize that. You can capitalize it. To that, you can use this formula directly, dt. So here in this case, I have not been given equity or value or KE or KO, but there is a formula for value of levered firm calculation in case of debt. In case of debt, as per this formula approach, value of unlevered firm being 80,000 rupees and debt component being 30,000 rupees. But entire debt component is not your gain. To the extent of tax, only our gain. The tax component in this case being 30%. Now this value being 89,000. This value being 89,000. This will be 89,000. Refer the working. Refer the working. This is very, very important concept. Now you can find out the equity. Equity being the balancing figure. How much is that? 59,000. You can calculate the rest. What is the KE? The KE in this case being NI divided by equity. 4,900 divided by 5,000, 59,000. I think this value being 8.31%. What about the KO value? KO value. Yes. Now here you can use the other way. You can use the other way. Okay. What's that? Weight of debt, cost of debt plus weight of equity plus cost of equity. That approach you can use it. Because there's a tax impact. You have to adjust for the tax impact, right? So it is not directly NY. There's a tax impact. You have to remove the tax. You have to remove the tax. So better you can use this formula. Okay, come on. Value of debt being, weight of debt being 30 out of 89. Cost of debt being 7% plus weight of equity being 59 out of 89. Cost of equity being 8.31. Come on, get me the final value here. I think it is 7.87%. 7.87%. Clear? Clear? Now, I will give the complete list regarding the levered firm valuation, unlevered firm valuation, and the tax model and the no tax model and all. In Singer Academy text, I have given a list of formulae for almost 1 page. But I request to memorize only few of them. That's more than enough. Rest you can score out. Okay? You no need to study all these things. Let's see here. Before I go further to summarize Modigliani-Miller approach, okay, let me give the views about the Modigliani-Miller and criticism of Modigliani-Miller, then I can proceed. Okay. Now, Modigliani-Miller approach on cost of capital. Capital structure does not affect the cost of capital and value of the firm also. Right. Clear? And his view that corporate has no taxes. As he says that we don't have any tax because NI, NY, TI, traditional approach, and all the approaches we assume that we don't have the taxes. Based on that, Modigliani-Miller also gave his own opinion, assuming that there is no taxes. So he presented his own ideas and theories in front of the scholars, and they started criticizing which world we don't have the tax. Definitely corporate will have tax. So as the corporate has a tax, you are not included that tax in your calculations. Your theory is not working properly. So lots of criticism came here with respect to no tax impact, no tax assumption. So the presentation of his theory in 1958 redrafted in 1963 by adding that tax also in his corporate taxation theory. He has included the corporate tax also in his own theory. So in 1958, he starts with the no tax assumption and reassumed in 1963 with the tax assumption. So as per NY approach, no tax stands correct, and as he includes the tax in NA approach, automatically that by adding the tax, it becomes NA approach like. Is that okay? Clear? So these are the two criticisms you have to understand. Now let's see a small theory here. Propositions of theory here. We'll deal this thing in detail now. In case of without tax, value of the firm is equal to value of a levered firm is equal to value of unlevered firm. Value of unlevered firm. And that too, you can calculate this way. How? NOI divided by KO. You can use this method here. You'll get the same formula. You can get the same value, sorry. Okay, value of levered firm. You'll get the same value. Clear? Value of levered firm. Now, this is point number 1. Second point, what about the KEs are? KE is nothing but KO plus KO minus KD into D bar E. In the very beginning, I just gave the chocolate example for this one, right? So, whatever the chocolate I bring for the students, some of them say we don't take. Those who have not taken this will be shared by equity shareholders. So, I thought I can give around 10% return. Debenture holder says I can get only 5%. That's okay. Balance 5% not required or not taken by the debenture holders is now taken by the equity shareholders. That's why it's in denominator. That's how KE gets affected. KE gets affected. These are the two propositions you have to understand in case of theory. Proposition 1 is the value of levered firm is equal to value of unlevered firm. KE gets adjusted due to this reason. So KO plus any benefit due to the inclusion of the debenture holders will be taken by the equity shareholders. That second component, KO minus KD into debt by equity, will be the second component. Clear? Now, what happens if we include tax? What we have calculated here is assuming no tax, without tax case. If I include tax, then the value of levered firm is equal to value of unlevered firm plus. Because of the tax component, there is a savings in your expenses. Whenever you are paying any interest, that interest can be debited to the P&L account. That ultimately reduces the tax payment. Okay, reduces the tax payment. If any reduction in tax payment is a gain only, no. To the extent of tax savings will give a boost in the value. The tax savings happens only due to the debenture. So, to the extent of debt multiplied with the tax extent will have the improved or increased value in the levered companies, right? DT will be the extra point that you have to understand in case of tax model. Clear? Or you can use the other formula. Not only simply NY into 1 minus T will be taken divided by KO along with the tax. Along with the tax, you have to multiply the 1 minus T with the NY. So, you will get the NY after tax divided by KO will be used here. Clear? This value. So, this value can be calculated either the KO model what we have learned in cost of capital, or you can use this model also. You will get the same answer. No issues. Then what happens in case of KE, sir? Under this, KE is equal to okay, cost of overall cost of capital of unlevered firm plus cost of equity of levered firm is equal to cost of overall capital of unlevered firm plus, or simply you can put this way, KO plus KD, the same formula. Okay, same formula, but D by E, everything is same to the earlier one. But don't forget to multiply with 1 minus T. This is the new one you have to add in case tax is included here. Tax is included here. This formula remains the same, but we include 1 minus T here. Clear? And remember, all these values, what we have shown here, will be before tax. This KE will be the levered firm's KE. These are the two items you have to keep in your mind. So, one is all about value of levered firm is equal to value of unlevered firm in general. And K is equal to KO plus KO minus KD into D by E, also be general. We have already studied this along with the NY approach. In case of Modiglian-Miller tax approach, there is a slight difference. Because of inclusion of tax, there is a savings in your cost because of lower payment of tax by debiting the interest in the penal account. To the extent of savings, will have some extra value. That value is nothing but D into T. So, value of the levered firm will be increasing by DT extent. As well as KE will also be having some savings. It's not original KE. So, usual KE, what you calculate under tax model will be calculated as it is, but finally you have to multiply with 1 minus T. That's all. 1 minus T. This you have to understand. And finally, one more variant, I request you to memorize this formula. In case of KO, is that okay? In case of KO, cost of equity of unlevered firm, open bracket 1 minus T into debt by value of the firm. You can memorize this formula also for the calculation of KO in case of with the tax model, with the tax T, okay, KO. Here KE of unlevered firm, okay. So this is nothing but shuffling this formula, you will get this one. You can simply memorize this one. So for the Modiglian-Miller, of course, you can understand this one very easily because this is an earlier one concept only. In case of tax, we include what? These are the two items extra. Okay, this one is extra and here this one is extra. In this case, this one is extra. Okay, so you have to understand the 1 minus T will be included for tax model. In case of value, D into T will be used, that's all. But sometimes you need to calculate the KO inclusive of tax model. Okay, in this case, KO can be calculated this way also. KE, open bracket 1 minus open bracket T into D by V, close brackets. That's how you can understand this formula. Hope you have to memorize it. You can easily memorize this one also, right? I hope that you can easily memorize. These are the predominant formula you have to understand. Beyond that, you don't memorize any other things. Now for this illustration, I can use this formula also. For the KO calculation. So we got the KO being 7.87 by using this formula. We can calculate using this formula also. Let's try. KE. What's the KE here? KE of unlevered firm. Yeah, tell me. 8.75. This KE is not 8.31, it's 8.75. Unlevered firm's KE. You can also use subscript like U, unlevered firm, if you want to make it clear. 1 minus tax rate being 0.3 into debt being, how much is the debt? 30,000. What is the value? 89,000. Yes, come on, find out the value here, one after one. 8.75 1 minus, get me this value first of all. 30 by 89 into 0.3. 0.1011. Come on. 1 minus 0.1011 into 8.75. Okay, you'll get the same answer. Is that clear? Hope you'll be now able to understand. I request you to memorize these formulae at least, not beyond that. You don't need to go with all the models I have given in Singer Academy text, of course not required. So I have referred most of the books and they have confined with this formula only. So others not required. You can memorize this. So now let's move on to the next one, arbitrage process. Once arbitrage process is over, then we'll get back to understanding the Modigliani-Miller's assumption and criticism and all some theory portion. So with that, entire thing will be over. Come on, get me finish this one as soon as possible. Come on, make it faster. We'll move on to the question number 5. Arbitrage process with homemade leverage. Okay. There are two companies, SSA Limited and SPB Limited, having same EBIT of 12,000 rupees. SBB Limited is a levered one, so this one is levered, and SSA Limited being unlevered. Yes, have the 9 lines here: equity, debt, value, NOI minus interest, you will get NI, KE, KD, KO. In case of SSA, EBIT being 12,000 rupees, EBIT being 12,000 rupees, having same EBIT, okay, 12,000 rupees. Similarly, another one is SBB. This one is levered firm with 40,000 rupees debt, carrying 6% rate of interest. The cost of equity of SSA Limited is 12%. Cost of equity, SSA Limited cost of equity 12%. And KE of SBB Limited is 16% in scenario A. KE 16%. Right. Find out whether arbitrage exists or not. Come on, calculate as usual method. You finish up all the 9 lines here. In SSA, we don't have debt, no interest, NI being 12,000 rupees. You can calculate the debt easily, value easily. Come on, calculate the value here. Value, yes, NI by NY divided by KO. As it is being unlevered firm, this is levered firm, this is unlevered firm. KE is equal to KO in absence of debt. So KE is equal to KO. Now value can be easily found out here. NY divided by 12%, 1 lakh. Equity also the same, value is also same. So I have completed all the 9 lines for SSA. Similarly for SBB, NY being 12,000 rupees, we have the debt rupees 40,000, for that interest being 6%, 2,400. NA is 9,600. NA is 9,600. Now, we have been given the KE, so you can calculate the equity directly, NI by KE. based on the available information. 9,600 divided by 6 percentage, 60,000 rupees. Then the total value being 1 lakh. What about the KO? KO is nothing but NOI divided by value. 12,000 divided by 1 lakh, 12 percentage. What is the Martingale Miller's view? What about the Martingale Miller's view? Value remains same, KO remains same. Okay. So when you save money by adding the lower cost finance like debt, the benefit is taken by the equity shareholders, is not beneficial for the company. That's the logic here. SSA and SBB. So as per his statement, it is true only. It is true only. The value remains 1 lakh. Either it may be SSA or SBB. And KO remains the same, 12% and 12%. And equity shareholders in case of SSA gets 12%, SBB gets 16%. Is there any arbitrage? Is there any arbitrage? Arbitrage means moving from one to the other will be called arbitrage. If in one market you get the tomato or potato, whatever it may be, per kg 100 rupees, in another market is 50 rupees. What will be your intention then? Try to purchase from 50 rupees market and sell in 100 rupees market to make the profit. So buying from one place and selling in another place, making the profit because of doing this operation is called arbitrage. Or today rate being 100, tomorrow rate being 120. So what will you do? You buy today and sell tomorrow. So this way also you can do the arbitrage. So arbitrage is nothing but buying and selling and making profit, where buying happens in one place and selling happens in another place. Or buying and selling in two different times, buying today and selling tomorrow. Because of that also you can make the profit, also be arbitrage. In this case, buying, selling like arbitrage, right? You can sell your SSA shares and buy SBB shares, or sell SBB shares and buy SSA shares. Such a way you can make the profit. That's called arbitrage. Now the question is there any arbitrage? So if you are being the shareholder of SSA, what could be your return? 12%. If you want to get 16%, what do you have to do? Sell the shares in SSA, jump to SBB Limited. By selling here and moving there, you will be getting 4% extra. Will you do so? Definitely you don't do so, because moving from SSA to SBB creates extra risk. There's a debt. So as SSA being unlevered firm, less riskier, less return, 12%, you're pretty happy. If you are moving from this one to SBB Limited, more riskier, of course, 4% extra you are getting only because of the riskiness. Martingale Miller argues that you don't do this. So SBB CFO says that I'm able to give 16% return to the equity shareholders, while SSA gives only 12%. Come and invest in our company. Immediately Martingale Miller now coming for the solution here. No sir, you don't do so. If you want to give more profit, work better and get more revenue. Not this way. You are adding the debt, and by adding the debt, you save some extra payment. That payment is offered to the equity shareholders. It's not your duty. Okay, if you want to get more revenue, you have to work better, make more profit, not this gimmick like the capital structure decision will not be done by you. Sir, anyhow, I am doing favor only, no. Immediately he says with a homemade example, that is called homemade arbitrage. So if you are being the shareholder in SSA, you want to shift to SBB. Rather than shifting from SSA to SBB, you can do this way. If you are being 10% shareholder in SSA, okay, 10% shareholder in SSA, okay, equity share capital in SSA being 10%, around 1,000 rupees or 10,000 rupees. Equity share capital being 10,000 rupees. Clear? He says that invest 6,000 rupees only in SBB. Okay, invest only 6,000. Where? In SBB. So from SSA to SBB. If you are keeping 10,000 rupees here, right? If you are keeping 10,000 here, you are getting only 12%, right? So for 6,000 rupees, you will be getting 12%, means 7,000, 720 you are getting. You withdraw 6,000 from SSA, invest that in SBB. How can you invest? See, I make slide arrangement here this way. Out of 6,000 rupees, your money in SSA is withdrawn. Borrow 4,000 rupees. Borrow 4,000 rupees. From where do I get this 4,000, sir? The debt to equity mix of SBB. I withdraw 6,000 from SSA, carrying 6,000 rupees. And now I just go and check what about the debt equity ratio in SBB. 6:4 for every 60,000, debt component being 40,000 rupees. So 6,000 my money, I am withdrawing 4,000, I am borrowing 4,000 rupees from my personal capacity, making it 10,000 rupees. Making it 10,000 rupees. Is that okay? I can do this way. So let me redraft completely. I go from SBB to SSA like so that it will be more clear for you. I am withdrawing 10% from here. 10% of my holding being how much? 6,000 rupees. 6,000 rupees. And now I borrow from market at the rate applicable for SBB 6% rate. How much? 4,000 rupees. 4,000 rupees. I withdraw my holding in SBB 10%. Borrow debt to the extent available in SBB, debt equity ratio. Same way I am borrowing from my personal capacity. 10,000 rupees is invested in SSA. So sell in SBB levered firm, invest in SSA unlevered firm. I am selling from SBB, investing in SSA. SBB being the levered one, by selling I am getting 6,000 rupees. Before I invest in SSA, I borrow the amount equivalent to the debt equity mix of SBB at my personal capacity and I am making it 10,000 rupees. Now, as I invested in SSA, what about my return? My return being 12% in SSA. If I am keeping that money in SBB, I may be getting 12%, but now I am getting only 12%. 12% on this being 1,200. For this 1,200, I had to pay the interest for my borrowing. For the 4,000 rupees, 6%. 240, I had to pay the money. So left with my own personal benefit being 960 for my own investment. What is my own investment? My own investment being 6,000. So 960 I am getting for my own investment of 6,000. Then what about my ultimate return? 16%. So SSA being unlevered firm offers you 12%, SPB being the levered firm offers 16%, and CFO of SPB says, I am capable of giving more revenue. Then Morgan Miller comes for the argument, don't do so. You are not actually working better. Okay, if a 10% shareholder in your company can withdraw from your company and he can create the debt equal to your own company's structure by his own personal debt and invest that in SSA, withdraw the money at the rate of 12% in SSA, and from that withdrawal he can offer for interest and balance left over for his own money will be always equal to 16%. So if you want to give good return to the equity shareholders, work better. Improve the sales from 1 lakh to 1,20,000 rupees, or your profitability being 10 to 12%. That's how you can improve. It is not just changing the equity mix composition. Increasing the equity shareholders return is not meaningful. I don't accept. That's how he gave the solution. This is called homemade arbitrage. Hope now you'll be able to understand. What's that? SBB company borrowed 40,000 rupees at a rate of 6%. Will it be possible to borrow the same number at the same rate by an individual person? Which is not practically possible. For example, Tata company. Tata company can borrow with much cheaper rate. Is it possible for me, being the Tata company shareholder, stating that as per the Companies Act, I am the owner of the company, if you are holder of any even single share, I am the owner of Tata company, give me the loan. Never you will get the loan. So personal capacity cannot be compared with the corporate borrowing power. So that's how the criticism started here. A lot of criticism. Let me explain all the criticism all related to the Morgan Miller. Okay. Here, the change in debt equity ratio changes the risk element of the company, which in turn changes the expectation of the shareholders. This is the logic. So, if you are increasing the debt equity ratio, the risk element is increasing. If the debt equity ratio is decreasing, the debt risk element is decreasing, equity shareholders will demand lesser. Because of this reason only, equity shareholders' demand will be equal to KO plus KO minus KD into D bar E. This is pre-tax. In case of post-tax, you just multiply 1 minus T with this, right? Assumptions of the approach. So before he used this idea, he has given some assumption. I used these assumptions for calculation of this theory. Number one being perfect capital market. Perfect capital market. Perfect capital market means any information available for anybody will be circulated throughout the market, all the participants. If any company wants to disclose any information, it will be disclosed to all the investors immediately. And by selling one company shares and buying in another company shares involving no any transaction cost. That's what about his own view. So what happened here in this illustration? He has sold the shares in SBB and invested here the same money. But while selling, he has to pay some brokerage and there may be capital gains and all. While investing in SSA, again, there is a brokerage and also he has not considered. So there is no transaction cost. That's what about the predominant assumption here. Perfect capital market. Perfect capital market. All information is freely available, no transaction cost. This is what about the main assumption. And SSA and SBB both are doing the same related business. If SBB is doing a business and the same business is done by SBB, their risk is also same, which is not practically not possible, right? Okay, a shop nearby bus stand as well as a shop almost 15 kilometers away from the bus stand will have different earning capacity. How can you say both are same? So, but he assumes both are having the same nature. Firms can be grouped homogeneous risk classes based on the business risk. It's not so. All investors are rational. All the investors are rational. Always think about the cause and effect. Why do I invest here? Because this company gives more profit. Before invest, always the investors are thinking company A is superior than the company B. If the company gives you 12% return, company B gives 10% return. In which company do you want to invest? So naturally you think the company A is superior, you want to invest in A company. This is called logical thinking, but it is not in reality. Okay, you may fond up with B. So when I had a chat with lots of investors, I was a trainer for the stock market investments for more than 10 to 15 years now and then. So lots of investors came to me for that ways. Okay, I just came with some funny answers from the investors. Why do you invest in that company, sir? My horoscope says if we invest in steel company, I will get good money. Oh my God. Somebody will say, sir, my lucky number is 10, not 12, so I invest in 10%. Somebody will say, sir, 8 rupees 80 paise, sir. If the number touches 8.8, definitely there will be pickup, so I invested. So some foolish decision will also be there. We cannot say that all the investors are being the rational. So, but Modigliani Miller says, all the investors are rational and homogeneous expectations. Homogeneous means my expectation 12%, your expectation also 12%. What about your expectation in your examination? Just a pass, sir. Sir, 60%, sir. 55. Depends. Huh? Your expectation is totally different. We cannot say that your expectations are always same, right? And whatever the earnings they do will be paid as a dividend, payout ratio being 100%. There is no even single penny retained earnings. That's also his own assumption. And he predominantly assumes no taxes. And because of that criticism, sometimes later in 1963, he removed this assumption only. The fifth one only removed. The rest of the assumption remains there. So friends, these are the assumptions practically not possible. And the criticism will also be on the same, right? So those are here. So propositions. One is value of the firm, another one is KE. These are the two proposals. Number one being cost of capital as well as value of the firm. And the next one being, what about the expectation of the shareholders? The expectation of shareholders is this one. These are the two proposals. So for the value of the firm, first one is given. For the second proportion, how the equity shareholders expectation changes, the second proportion. For these two proportion, these two formula is given here. And the criticism on hypothesis being rates of interest are not same for individuals and firm, isn't it? Homemade leverages. If the company borrows 40% of their capital, okay, from the outside at the rate of 6%, then I can also capable of borrowing the same 40% at the same rate as the company borrows, which is not practically possible. The homemade leverage is not perfect substitution for corporate leverage. Is that okay? The corporate's borrowing power is totally different with the individual's borrowing power. You cannot link these two, right? And the assumption that the transaction costs do not exist is not valid, which is not practically possible. And fourth one being the arbitrage is affected by institutional restrictions. So you say that you can purchase here and sell there immediately, which is not possible in case of institutional investors, right? So if you go and purchase 100 shares, 200 shares, you will be called as individual investor or small investors. If you want to invest a bulk amount, say 1%, 0.5% or 0.1%, like huge amount you are investing, then you will be usually called as institutional investors. Actually, the sale price in case of IPO, the rate may be cheaper for the institutional investors. If the amount fixed as 1,000 rupees for the individual buyers, it may be 950 for the institutional investors. They can purchase at discounted rate, provided they have to retain for at least 3 years. They cannot sell immediately in the market. So some lock-in period is there. So the working of arbitrage is affected by institutional restrictions, because the institutional investors are not allowed to practice homemade leverages. They cannot sell here and buy there as they wish. Even mutual fund also cannot do so. So as they are not allowed, then this will not work here. Then fifth one is the major limitation of theory is corporate taxes. So whatever the assumptions he has given, no, those assumptions were the predominant criticisms while he presents his theory, and later only the last one, the tax is removed. The tax, no tax assumption is removed in 1963. Clear? Now, in this case, you can understand no benefit at all. That's called no arbitrage gain exists. No arbitrage gain exists. The illustration I have given you here is nothing but homemade leverage. Okay, so by shifting from SBB to SSA, the equity shareholders will get the value equal to SBB only. But if it gets more than that or less than that, there will be chances of arbitrage. Okay, if you are purchasing in one market for 10 rupees, the another market also the price is same 10. There is no benefit. But in one market is 10, the other market is 12, then definitely you will move from here to there. So here what happens? The value remains same. The value remains same and the KO remains same. It means there is no arbitrage. There is no arbitrage gain. No one will shift. No one will shift from SBB to SSA. I have chosen SSA. Though 12% is offered, I am very happy because risk is lesser. If I am being the risk taker, then I can invest in SBB. Okay, so I don't move from SBB to SSA here, okay, by using the homemade leverage because there is no any benefit. But the question is, find out whether arbitrage exists or not. Okay, arbitrage exists or not. No, but if the KE of SBB is 12.5%, it may be totally different case. Let's see. SBB scenario B. Okay, we have been given debt, NY, rate of interest. We have been given KE being 12.5%. 12.5%. Come on, try to solve this one. Out of 12,000 for the debt, 40,000 rupees, the rate of interest being 6%, 2,400 is subtracted. So 9,400 will be the net income for the equity shareholders. NI is also available, KE is also available. You can calculate the equity easily. Huh? 9,600. Yes, come on, tell me. What about the equity value? NI divided by 12.5%. 9,600 divided by 12.5%. What is the value? Huh? 76,000. What is the value of the firm? And what about the KO? KO, NOI divided by value. 10 point. So as per the NOI approach, means Modiglin-Miller approach, value will not be changed. KO also will not be changed. These two are constant. But here what happens? Value is higher. Then SBB seems to be overvalued one. If SBB being overvalued, what do you do? Sell the overvalued share and purchase the undervalued share. In the market, this company's share value is 1,16,000. The other company is only 1 lakh. Levered company value is 1,16,800. Unlevered company's value is 1 lakh. Where do you want to invest? SSA is cheaper. Go and invest in SSA. If you are being the shareholder in SBB, you sell the shares in SBB, go back to SSA. So because in this case, SBB seems to be overvalued. If it is being overvalued, you start sell the share in SBB and move to SSA. Is that okay? For example, we have two market 1 and market 2. The price per kg of tomato, okay, tomato per kg being 100 and here 50. What happens here? You start buying from here and sell here. If you do, what happens? You will get good money. So just think over 1000 kg you purchase today at 50 and 1000 kg sold in the market number 1 at 100 rupees each. So 50 rupees per kg for 1000 kgs, 50,000 rupees gain. What will you do? First you discontinue my class. You start operating that business. The next moment your friend asks, what happens to you? You don't attend the classes? I don't want to attend the classes, but every day I am able to make 50,000 rupees profit. How? Then you just explain. So here it's 50, there 100. Your friend, the next day he starts purchasing here. Don't sell to my friend. Sell to me at 55. There in the first market, don't buy to my friend. You buy it from me. I will sell at 95. Then it will spread to other and he will come. I'll purchase at 70. I'll sell it at 80 rupees. Then friend 1 is lost his business. Friend 2 also lost his business. Later on, here also 75, here also 75. So that happens in case of arbitrage. If there is a good profit by buying one place and selling in another place, automatically lots of investors or lots of business people will enter here to make the profit by doing the arbitrage. Because of doing this arbitrage, gradually the margin will be decreasing. Sometimes later it becomes non-profitable. Here also 75, there also 75, no profit. Or here it may be 74 and here may be 76. By buying here and selling there 76 rupees, transport charges and other charges will be another 2 rupees, nothing will be left over in your hand. Is that okay? So arbitrage happens until there is a profit from transferring from one to other place. Okay, the moment huge profit is there, the lots of traders will come to do arbitrage. They are called arbitragers. So they will buy and sell in another place so that margin will be gradually decreasing. As per the Modiglin-Miller approach, the SBB seems to be 1,16,800. Here it's 1 lakh. Definitely arbitragers will come by selling 1,16,800 and buying 1 lakh rupees. They will be getting around 16,800. This will keep on happening until how many days? Until these two prices becomes equal. Why the value of levered and unlevered firm being equal? Because of the arbitrage reason. That's how he has given the conclusion. Right. So what happens in case 20% of KE being 20%? We calculate here. So scenario C, SBB scenario C. And debt being same 40,000 rupees. And overall NOI being 12,000 rupees, interest at the rate of 6% and 40,000 being 2,400 and NI being 9,600. What about the KD here? The KD remains the same 6%. Now come on, get me the value for equity. 9,600 divided by 20%. What is the value? 48,000. Then overall value is 88,000. Now what about the KO? NOI divided by value. So 12,000 divided by 88,000. 13.63%. Okay. Now what happens? SBB seems to be undervalued share. Arbitrage Exist or not? Yes, because it's undervalued. Undervalued. Then what happens? You sell the shares in SSA and start investing in the undervalued share. It's cheaper. Here the bill being 10 rupees, here the bill being 8 rupees 80 paise. Where do you want to purchase? Only the share which has undervalued. You just go and purchase here. Is that clear? Find out whether arbitrage exists or not. So we have completed. Explain the arbitrage process and find the gain if arbitrage exists. So I'll just explain this after. So now let's see this scenario. Here arbitrage exists, here also arbitrage exists in two cases. Let me start with the first one. Shifting from SBB to SSA. What is the gain you have? You just have this format, that's more than enough. If you already have in SBB, you want to shift to SSA. Right. You shift to SSA. We assume that we have 10% investment. 10% investment. If you are being the investor in SBB, you may have how much? 76,800 is the equity. You are holding 10% on this. How much is that? 7,680. What about your personal debt? You don't have your personal debt. Overall investment being 7,680 in your SBB account. SBB shares. This is SBB. What about your return? Return on equity. As per SBB, you will be getting 12.5% on this. 12.5% on this being 960. Do you want to pay any interest? Personally, you don't have any borrowings. You don't need to pay any interest for this. Then entire 960 is for your own fund only. Okay, return on your own fund. Own fund return. Is that clear? Now, if you want to shift from SBB to SSA, you want to expect to get the same return, right? So, you are planning to shift from SBB to SSA. How much do you want to get? You want to get only 960. As you plan to shift from SBB to SSA, means levered to unlevered, you need to borrow debt equivalent to the debt equity ratio of the levered firm out of your own personal capacity. Okay, 10%. For the 10% in SBB, what is the debt component you have? 4,000. 40,000 rupees is the overall debt. Out of that, 10% is your investment, means 4,000 will be the debt component. You try to borrow 4,000 rupees out of your personal capacity. Right, personal capacity. For that 4,000 rupees, how much you have to pay the interest at the rate of 6%, which is not practically possible, but he says so. If corporate can borrow 6%, borrow at the rate of 6%, you can also borrow at 6%. That's how the criticism also we have studied, right? So criticism is there. So for 4,000 rupees, 240 rupees should be your interest. And how much you need to earn now from SSA? 1,200 rupees you have to earn. 1,200 rupees you have to earn. To earn 1,200 in SSA, how much should be your investment? In SSA, you will be getting 12% return. For the 1,200 rupees, how much you need to invest? 10,000 rupees. Am I right? 10,000 rupees. This is a reverse calculation. This one is reverse calculation. This 10,000 is nothing but 1,200 divided by 12%. Working note. So out of 10,000 rupees, debt being 4,000, balance leftover value being 6,000. So from this, it is very clear. You have withdrawn 7,680 from SBB Out of that, only 6,000 invested in SSA, together with the borrowing matching with the levered firm's borrowing 4,000. You invested 10,000 rupees. For the investment, 1,200 rupees you are getting. After leaving the interest, you will getting ended means you will get around 960 rupees for your own fund, which is equivalent to the return what you can get in SBB. You will be getting here also, right? Clear? What is your savings here due to this? You saved the difference between these two. 1,680 rupees your investment is saved. Your investment is saved. 1,680. Clear? So you now under invest by 1,080. You withdraw and invest in another company. Still you have left with 1,680 rupees in your hand. Clear? Now what happens in case SSA to SBB in the second scenario? In this second scenario, because here SBB is undervalued company, SSA is overvalued company. So you have to move from overvalued company to undervalued. So here it's a reverse case. We start with SSA. Assume that same 10% investment already have in SSA. How much is that? For 1 lakh, your investment being 10,000 rupees in SSA. Is that okay? So overall investment being 1 lakh, sorry, 10,000 rupees, 10,000 rupees, and ROE in this case being from SSA you are getting 12%, 1,200 rupees, and interest nothing. You will be getting 1,200 rupees for your own fund. In SSA, if you are being 10% invested for 10,000 rupees, you are getting 1,200 rupees. Return on one fund being 1,200. Now you plan to shift from SSA to SBB. What's your ultimate goal? You have to get the same 1,200 rupees. You have to get the same 1,200. And in this company, the same 4,000 debt is also there. You assume that the debt borrowed by the company, they themselves, you don't borrow. For the 4,000 rupees, 240 will be interest payment. Then what about the ultimate value? 960 should be your money. 960 should be your money. Here 1,200, 960 minus 240, here reverse. 1,200 minus 240, 960. Reverse. You understand? 4,000 will be the debt equivalent value in SBB, but here the calculation is reversed. Then what about the total return you expect? Only 960. To earn the 960 in SBB, how much you need to invest? Come on, tell me. 960. At the rate of 13.63%. Make it faster. Otherwise, for equity, I can calculate this way. It's very simple. 4,800. Then overall investment requirement being 8,800. So in SSA, you need to invest 10,000 rupees. In SBB, you have to invest only 8,800. You save in investment by 1,200. You are investing lesser by 1,200. You are pretty happy with that. Clear? This one is the other approach. Be careful this calculation. If it is clear, text me. Online students, come on, make it faster. So with that, we have completed all the models, all the theories. Four theories were there, right? So NI, NY, TA as well as MM theory. Now you can recap this. Capital structure relevance as well as irrelevance. Capital structure is not a relevant for us, which is as per NOI approach. And no, sir, capital structure will also have the relevance in profitability. For this, we have two theories, NA approach as well as traditional approach. And later, Modigliani Miller came. He simply says that this will be true, sir, where he has not included tax calculations here. And after criticism, he started including the taxation. Once he included, then he came to know capital structure will have the relevance. That's how he has given these two models. The company's value remains same here. Value of levered firm is equal to value of unlevered firm in this case. But in this approach, by including the taxation, value of levered firm is equal to value of unlevered firm plus to the extent of tax saved on D will have additional value for the company in case of levered firm. That's how he has now given. Now these two are not equal. Okay. Value of levered and value of unlevered firm is not equal. That's what about the cases. Apart from that, the CFO will have their own his own experienced ideas for designing the capital structure, may be called as a trade-off theory as well as pecking order theory. Pecking order theory. Okay, pecking order theory means if you want to purchase a commodity in the market, it may be say 10 percentage, 10 rupees and 15 rupees and 5 rupees and 7 rupees. Then how can you choose here? Usually choose 5 rupees goods first of all. But it seems to be stale and 7 rupees commodity may be fresh. So then automatically go for 7 rather than 5. So you have your own logic to choose the best commodity in the market. Similarly, the CFO has various sources also like equity shares, debentures, preference shares and retained earnings. And in case of long-term debt, yes, of course, he may have the debentures as well as other government T-bonds and all. He may choose as he wishes, seems to be cheaper as well as riskiness to repay. Okay, he needs a fund only for the short term, then he can borrow from other sources. He needs the money for the long term, infinite period, then he can issue the shares and raise the fund. So that's what about the pecking order theory. And trade-off theory is the risk and return analysis. So he has to minimize the risk and maximize the return. Using that logic, he can arrange his own source of fund also, right? This is a pure theory. As per the trade-off theory, always cross-verifies whether cost of debt is cheaper and compared to the benefit of debt. If the cost of debt being 10% and by investing this, your benefit being 12%, then you can go and borrow. Else you don't borrow. That's what about the trade-off theory. So what are the benefits of debt we have? By borrowing, then you will be getting tax benefit. Sometimes you may have the chance to borrow at much lower rate. Lesser KD as well as tax benefit. These two benefits we have because of borrowing. But what could be the cost of debt? The cost of debt could be financial distress and agency cost. These are the two problems we have. What about the financial distress, sir? If you borrow, then if you are not able to repay the interest or installments in due date, then the debenture holders will pressurize to close the business and settle the money. Now, solvency will be a trouble for us. So, because of that, the company will go for the bankruptcy. In case of bankruptcy, in case of emergency requirement, they can sell at distressed price. Probably a property can be sellable for 100 crores. Because of the emergency, it will be sellable only for 40 or 50 crores. That's all. Because of the emergency, the sale price will be drastically down. So you will be losing that. That's called bankruptcy cost. And assets will be saleable at distress price. Distress price means the lower price. Okay. And legal cost. So we have to defend our position also. It involves some legal costs. These are called bankruptcy related costs, direct costs. We have still non-bankruptcy costs that will be incorporate indirect costs. What could be the non-bankruptcy? It's not affecting my business to close, but somehow it will be a cost for me. For example, payment terms. I think I can repay this in a matter of 2 years later, but the lender will say, no, sir, you have to repay only by the end of fifth year. I get the money by the end of second year itself, but I cannot repay this, but the debenture holders demands to repay only by fifth year, because the lender gives me the borrowings, means amount, only expecting that he will get interest for 5 years. If I am repaying in second year itself, then he will be loser for interest for the remaining 3 years. No, they will not allow. Even in banks, if you bought the home loan, the term may be 15 years or 20 years. If you foreclose that 4 or 50 year itself, then they will demand an extra amount called foreclosure charges. Similarly, here also we have, of course, it's not bankruptcy, but of course we have to fulfill their demand because of borrowing. So bank payment terms and cost of customers and managers, these also be additional costs we have to incur in case of financing out of the debt. Agency cost is nothing but who is the agent for the company? The person who is running the business is the agent, right? Usually board of directors. Board of directors are directly controlled by whom? Equity shareholders. They are appointed by the equity shareholders. If the company is not giving proper EMI amount or installments or interest to the debenture holders, then in board of directors they will also come and sit and demand our commitment to be fulfilled. And there is no other way. You have to obey what the others say or what the debenture holders are stating. Cost of monitoring management. Shareholder managers conflict will be there, and shareholders debt holders conflict will be there. Shareholders will say, so we'll appoint Mr. A, and debenture holders will say, no, B should be appointed. I cannot now neglect his own demand. If we neglect, then he says that you have to settle the interest and installment in prompt days. If we fail so, then he will also demand we have to recruit our own directors in this business. Automatically now we will be losing our own control over this business. So always check with the benefits of debt as well as cost of debt. If the benefit is higher, then you can go for the benefits, else go for the cost of debt. Clear? That's what about the first one. The second theory is all about pecking order theory. Otherwise, it's a manager's choice. Myers stated this one. Okay. Pecking order theory or manager's choice. I already told you, 4 or 5 different rates are there for the same product. Now it's your choice which of products may be cheaper for you, can choose. So financing choice of manager, internal finance, debt, equity. He has 3 choices. Internal finance, retained earnings and debt, or he can go for the equity, even preference shares. In case of internal finance, usually KR is cheaper than the KE in general, right? So already we have studied in the cost of capital, KR is equal to KE is the first approach. The other approach, K is usually lesser than the KE because of the flotation cost as well as personal taxation. So always the financial means CFO will take the cheapest financing source, which is KR. So he will prefer go for KR. And second one being KD. KD will be cheaper than KE. So his second choice will go for the debt. But chosen only if the return is assured. If the return seems to be unassured, so you will not go for the debentures, because you have to give the interest year after year without any default. But if you don't get the return, of course, you have to give them somehow by exploiting the equity shareholders fund. In case of retained earnings is reinvested, then of course, if we don't have any income, we no need to pay any money for that. So again, it's a decision of the CFO. Finally, there is no other option. You can go for equity, though it may be costlier. And this option will be chosen if the return is unassured and the money is not required to be refundable for n number of years. Then they can go for choosing equity. So 3 sources are there. He can now choose one of the best one as he considers. Factors affecting capital structure. What are the factors that are affecting the capital structure? Financial leverage, trading on equity. Number 1. Some business will say, probably managers will say, our business will be always based on the equity only, not debt. We never have the debt policy. We don't never borrow debt. Some companies now also, I had a company's view. They say debt-free company. We don't need to borrow even single penny. Though there may be predominant expansion possible, and they can if they invest for 10 lakhs, they can get around 20 lakhs profit also. But for the 10 lakhs, they need to borrow. their policy, we don't need to borrow at any cost. So they can repay the borrowings along with the interest, yet they can make huge profit, but their policy is not to go for borrowing. It's their default policy. So I want to borrow and do business, then it's called debt policy. No, sir, I never bothered, then it is called trading on equity policy. So based on that, they can make the decision. Second one is growth and stability, cost principle, risk principle, control principle, flexibility, other consideration. Cost principle means minimize the KO is the intention. To minimize the KO, you have to source out of the debt. Next one is risk principle. If I borrow, then it's a risk. So I don't want to borrow. That will also be a reason. I'm being the risk taker, then I can go and borrow the money also. Riskier than equity financing. If the business is riskier, whether the profit is regularly coming or not, then there's a question mark for that. So then automatically they will go for equity financing. Control principles. If they get money, right, from debt, okay, so requires control than equity financing, okay. If they borrow, then they will also come for the controlling the business. So rather than not losing the control, we can source out of the equity only. That's how we can do the financing for the capital requirement. Flexibility. In case of equity, no, we cannot repay this. But in case of debentures, while issuing itself, we can fix the term for the returning that money. So there is a flexibility to rise as well as repayment in case of borrowings. But in case of this one, equity, we cannot repay, okay. Fund requirement temporary, then debt financing will be suitable. Other consideration like nature of industry, competition, timing of issue, all these things also be a matter here. Now, what is the optimum capital structure? So we have, these are the ideas, okay. EBIT, EPS, MPS, okay. Some ideas also we have, a small theory portions. I request you to have the view about this one, okay. This table will give a small idea about this one, so you can have the view about. Now, indifference point and financial break-even point. Indifference point and financial break-even point. Let me explain these two concepts with the illustration. It may be expected in your exams. I'll finish up the indifference point first of all. What is called indifference point? Okay, debt to equity, okay, maybe 30%, 70%, or 60%, 40%. Both will give you same benefit to the equity shareholders, then it is called debt to equity ratio, means indifference point. Whether you go for equity financing or small amount of debt financing or more amount of debt financing, doesn't matter. The EPS remains same. How? Such a way the EBIT should be there. So I have to find out the EBIT which gives the same EPS under different capital structure planning. For that, let's start with this example. Finding the indifference point as well as financial break-even point. Singer Limited provides you the following information. Calculate indifference point between financial plan 1 and 2, financial plan 2 and 3, and financial plan 1 and 3. Applicable tax rate being 40%. Here we have been given equity share capital, debenture, preference shares, as well as total capital requirement. In all the cases, the capital employed being 1 lakh only. In the very first case, the financial plan being sourcing by the equity shares only, unlevered firm. In the second one is levered firm. Third one is levered firm. Apart from that, preference share is also added. Now my question is, whatever the plan may be, either plan 1 or plan 2, my ultimate EPS will be the same. If I need to get the same EPS under financial plan 1 and 2, what could be the NOI? I have to determine that NOI. You just calculate the same model for calculating NI and NOI. What we have learned already can be used here. So we start with NOI or EBIT. Under first model, come on, tell me. What is the EBIT? I am not sure, so I will assume the EBIT being X minus interest. What is the interest for the first model? 0. And what about my EBT? X minus what? Tax. So the tax rate being 40%. 0.4x. What about the EAT? 0.6x minus what? Preference dividend if we have. Nothing is there. So earnings available to equity shareholders being 0.6x. Now what about the EPS? 0.6x is the earnings available to the equity shareholders divided by number of shares. What about the number of shares here? Equity share capital is divided by the market price per share. So 1 lakh per share being 25. If I divide this by 25, you will find out the number of equity shares here. 4,000 shares. This is what about the EPS in scenario 1. Scenario 1. Is that okay? Let's go for the scenario 2. In scenario 2, I need to get the same EPS. What could be the EBIT? I am not aware about that, so I assume the EBIT being X. And in scenario 2, we have the debentures rupees 60,000, the rate of interest applicable for being 10%, which is 6,000. Then EBT being X minus 6,000. And calculate tax at the rate of 40%. 40% being 0.4x minus 2,400. Ultimate value being 0.6x minus 3,600. No preference dividend. So earnings available to equity shareholders being 0.6x minus 3,600. Okay. Come on. What about the EPS? You have to divide this by number of shares. How many shares we have? Price per share being 20,000, number of equity share being 40,000, so 40,000 by 20, 2,000 equity shares. Is that okay? This is what about the EPS per share. Now, what about the indifference point between financial plan 1 and 2? Indifference point between 1 and 2. So, indifference point between 1 and 2, okay, means these two are same. 0.6x by 4,000 is equal to 0.6x minus 3,600 by 2,000. Am I right? Okay. You have to find out the x here. X being the EBIT. In that case, the EPS will be the same for option 1 as well as option 2. Okay. Now, this can be 2 or 0.3x. 0.3x. So, this is 0.3x, this is 0.3x. Then, x is equal to 3,600 divided by 0.3, I think. Am I right? Come on, find out the value. Say 12,000. Are you able to understand this calculation? Or do I want to give one more step here in between? See, this 2,000, or you can do the cross multiplication. Okay. 1,200x is equal to 2,400x minus 4,000 into 3,600. 1 crore? 44 lakhs. The number seems to be pretty massive. So 2,400x minus 1,200x is equal to 1 crore 44 lakhs. Now x is equal to, you will be getting this one. Okay, x is equal to 12,000. Okay, the other way, as already told you, no, you can multiply 2,000 in both the side. So if you multiply the 2,000, this denominator cancel, here it becomes 2, otherwise it is 0.3x. 0.3x is equal to 0.6x, otherwise 0.3x is equal to 3,600. That way also you can get it easily, right? Right. Now to find out the indifference point between financial plan 2 and 3, I need to get the third one also. I assume the EBIT being X and interest for the third plan being, we have the debt only 40,000 rupees for 10 percentage 4,000. X minus 4,000 will be the EBIT and tax being 0.4 X minus 1,600, EAT being 0.6 X minus 2,400. We have preference share also 2,000 rupees for that 15 percentage 3,000 will be the preference dividend. Then ultimate value being 0.6x minus 2,400 minus of minus 3,600 becomes 5,000. 3,000, right? 3,000. So 5,400. Now, what about the EPS? 0.6x minus 5,400 divided by number of shares, in this case being 40,000 per share, value in the market is 22,000. You divide this by 2,000 rupees. Now I am going to calculate the indifference point between 2 and 3. Indifference point between 2 and 3. So 0.6x minus 3,600. Okay. I'll work out here. I need space. Indifference point between 2 and 3. 0.6x minus 3,600 by 2,000 is equal to 0.6x minus 5,400 divided by 2,000. If you cancel, then you cannot get the answer here. Indeterminate. We cannot get the answer. 0.6x minus 3,600 is equal to 0.6x minus 5,400 ends with 0 is equal to 0x is equal to the difference between 5,400. So anything denominator being 0 will not be determinable. No answer here. Then indifference point between 1 and 2 can be tried. 1 and 3 can be tried. Indifference point for 1 being, the EPS for 1 being 0.6x divided by 4,000. And in case of 3, 0.6x minus 5,400 divided by 2,000. Denominator 2,000 can be removed by multiplying with the 2,000 in both the sides. Here the 4,000 becomes 2 or this is 0.3x. So then x is equal to 5,400. 0.6 minus 0.3, 0.3x should be the denominator value. What is the ultimate value? Come on. 18,000. So indifference point between financial plan 1 and 2, 12,000, 1 and 3, 18,000, 2 and 3, indeterminable. Okay. Now, the last question, financial break-even point. What is called financial break-even point? Financial break-even point. Financial break-even point is nothing but no need to worry about the equity shareholders. At least the financial commitment should be fulfilled. For that, how much you need to earn? Financial break-even point. Okay. The tax rate being 40%. Am I right? Now, financial break-even point. Okay, financial break-even point. Now, what happens in the first scenario? If you don't earn even single penny, what about the interest? No. What about the tax? No. Earnings available to the equity shareholders? No. Do you have any commitment? No. So in the very first scenario, your financial break-even point being 0. What about in the second scenario? You have to at least pay the interest. Okay. What about your interest commitment here? 6,000 being interest. If you earn 6,000 rupees, pay the interest, then it becomes 0. Tax and 0, 0, 0, 0, 0. So financial break-even point in plan number 2 being 6,000. What about in scenario 3? You have the preference shares also. For the debenture, you need to pay the interest. For the preference shareholders, you need to pay the preference dividend. Now come on, tell me, what about the financial break-even point? Otherwise, how much EBIT you need to earn? For this 4,000 rupees. For this, how much? 3,000 rupees is after tax. Then you need to earn before tax value. Okay. After tax, what the amount you left over? So if you think only 7,000, you pay 4,000 rupees and end up with 3,000 EBT tax 40%. 1,200 will go. 1,800 will be the amount you have for it. Where the preference dividend being 3,000, you end up with a negative. Then in case of preference dividend, you need to earn the tax amount also. So financial break-even point is equal to interest plus preference dividend before tax. After tax means you multiply with 1 minus t. Before tax means you have to divide that by 1 minus t. So preference dividend divided by 1 minus t is the final answer. This is what about the formula for the financial break-even point. For the scenario 3, interest being 4,000 and preference dividend being 3,000 and tax rate being 0.4, 1 minus 0.4. Now what is the value you are getting? 9,000 rupees. 5,000 plus 4,000, 9,000. If you have 9,000 rupees here, you pay interest 4,000 rupees, EBT being 5,000 rupees, tax at the rate of 40% on this 2,000 will go off. You will get 3,000 rupees can be used for paying the preference dividend and ended with 0 for the equity shareholders. Clear? The formula for financial break-even point being interest plus PD by 1 minus T. Okay, with that, this topic is completely over. I'll start the leverage in the next class. I need a fresh mind for that. So, most probably in the